In this module, we will be examining a company's cost structure and how that cost structure impacts on what we call operating leverage. To begin with, cost structure is a relative proportion of fixed versus variable costs that a company incurs. Now, this just doesn't happen. Companies carefully choose their cost structure. They determine the relative proportion of fixed costs to variable costs because this has a significant effect on profitability. Operating leverage is the extent that net income reacts to a given change in sales. Higher fixed costs relative to variable costs causes a company to have higher operating leverage. If sales revenues go up, the profits will go up very rapidly. However, if sales revenue goes down, leverage is a two-edged sword. The profits would go down very quickly. Here's an example, operating cost structure, changing the cost structure. Let's just take a company that has sales 800, variable cost 480, contribution margin 320 or 40%, fixed cost, net income 120. So when we want to look at the cost structure, we say, okay, the variable cost is 60% of sales and the fixed cost is $200,000. That's their cost structure. All right, now the total costs are 680, 480 variable, 200 fixed at this level of activity of 800,000. Now, if I propose a new cost structure, that is, I'm going to introduce into the manufacturing process some laser equipment. That would make the fixed cost increase by 100,000, but also save on variable costs by 100,000. So let's just assume at the same level of activity, 800,000, we now have variable costs of 380. They went down by 100. And we have fixed costs of 300,000. They went up by 100. We have a new contribution margin, 52.5. We have the same net income. So we're just taking that company, changing the cost structure to see what would happen with increases in sales. The new cost structure now has a variable cost, 47.5 of sales instead of 60%, and a fixed cost of 300,000 as compared to 200 before. Same costs, same total. Now, sales increases from 800 to 100,000. With the old cost structure, then my contribution margin would be 400,000 and my net income would be 200,000. With the new cost structure, if sales increase from 8 to 1 million, my contribution margin now would be 420,000. Fixed cost higher, but my net income is also higher. So when you look at it, profits increased by 80,000. When sales went up 200,000, profits increased by 80,000, or 66.6%. With the new cost structure, though, with the same increase in the level of activity, that is, sales goes from 800 to 1 million, profits go up 83.75%. That is, it was 120, well, now it's 2,500. So you can see a major increase in profits because of more fixed cost in the cost structure. Now we introduce the idea of operating leverage and the degree of operating leverage. Now that is calculated by dividing the contribution margin by the net income. So in this case, the degree of operating leverage is 2. For the new cost structure, the degree of operating leverage is 2.36. Let's take another example. Let's assume we have a company called Vargo and one called New Wave. Both make the same product. Both sell 800,000. Both have net income of 120. Vargo uses a traditional labor-intensive manufacturing process. New Wave is more automated, so it's what we call capital intensive. You can see that the variable cost for Vargo 480, but for New Wave 160, therefore a different contribution margin. But the fixed cost for Vargo is quite a bit lower than the fixed cost for New Wave. Now, what does this mean for the contribution margin ratio? Well, Vargo has a contribution margin ratio of 40%, but New Wave is double that, 80%. What does that effect mean on break even? Well, Vargo has a lower fixed cost but a low contribution margin ratio, and it has a lower break even. So you see, it's riskier to be New Wave because you have a higher level of activity is needed to break even. They have to generate 150 more in sales just to break even. What about the margin of safety? Well, again, here you see that Vargo has a higher margin of safety than New Wave. So that tells you New Wave is much more riskier than Vargo. And that is a big difference in the risk between New Wave and Vargo. That is, sales can decline 38% before Vargo is in a negative position, but only 19% before New Wave is in a negative position. What is the degree of operating leverage? Well, this provides a measure of a company's volatility, computed by dividing the contribution margin by the net income. And here you see that the degree of operating leverage for Vargo is 2.67, but for New Wave it's almost double that. It's 5.33. New Wave earnings can go up or down by 2 times as much given the same level of sales. That's what the degree of operating leverage is. Put it another way, let's just say that sales goes up 10%. Well, profits would go up 10% times 2.67, or 26.7% for Vargo. But if sales goes up 10% for New Wave, 10% times 5.33 means that profits will go up 53.3% for New Wave. And it also works when sales goes down. Sales will go down, the profit will go down twice as fast for New Wave as Vargo.